Today, is it time to sell in May and go away? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and news with a distinctively Australian flavour. Today, a quick market update, but also a little bit of a deep dive in some of the underlying drivers. And we're trying to answer the question as to whether, in fact, it's a good time to sell on the assumption that for the next few months the markets are going to go sideways or down. The Dow fell on Friday and posted its second weekly loss amid weakness in energy stocks following mixed quarterly results from oil majors ExxonMobil and Chevron. The Dow Jones Industrial fell 0.53% and the S&P 500 was down 0.72%, but it still posted its best monthly gain since last November. The Nasdaq Composite was down 0.85%. ExxonMobil reported first quarter results that topped Wall Street estimates as improving oil prices in the quarter bolstered growth, but its shares still slipped more than 2%. But Chevron, meanwhile, swung to a first quarter profit but missed analyst expectations on both the top and bottom lines, sending its shares more than 3% lower. Lower oil prices also weighed on energy as rising infections in India continue to muddy the outlook for crude oil demand. Crude oil for delivery in June fell 2.32% to hit $63.50 a barrel. Yet despite the losses on the day, energy was actually one of the best performing sectors in the first quarter. Higher oil prices and expectations of improving earnings for traditional brick-and-mortar stores led to greater returns within the energy and consumer discretionary sectors, according to a note from Wells Fargo. The day after the S&P 500 closed at a record high, Apple, Google parent Alphabet, and Facebook each gave back gains following upbeat quarterly reports this week. Amazon rounded off this week's wave of corporate earnings from the Fab Five with better than expected results, but it still gave up its intraday gains to close lower. They reported a blowout quarterly profit that topped expectations, underpinned by record profits for the quarter, partly thanks to its cloud business. Apple, meanwhile, closed more than 1% lower after the European Commission accused it of antitrust actions against music rivals following a complaint from Spotify. And Twitter slid more than 15% after its weaker second quarter revenue guidance and slower growth in quarter one offset better than expected quarterly profit and revenue. While mega-cap favourites posted largely strong earnings in the first quarter, their shares have struggled to maintain the upward trajectory that many had coming into the reporting season. There is a sense that maybe next quarter is as good as it's going to get, and we're going to roll over, particularly among the Nasdaq stocks and big tech stocks that benefited from the pandemic, said Jack Alban, Chief Investment Officer at Crescent Wealth Advisors in Florida. But combining just the revenue of four companies that are in the regulatory spotlight for the dominance of the tech sector and the American economy, Alphabet, Google, Amazon, Apple, and Facebook together gives us a combined revenue of more than $1 trillion in the 12 months of pandemic life in the US, running from the end of March 2020 to the same time in 21. If you add Microsoft, which of course we should also do, since it is on the cusp of becoming the second US company to ever claim a market capitalization of $2 trillion after Apple, and the growth in revenue comes out about $1.2 trillion. That is equivalent to a top 20 gross domestic product of some countries, roughly the size of the Mexican or Indonesian economies before the pandemic, which has a negative effect on those countries' output, while seemingly only boosting big tech. Out of that $1.2 trillion in revenue, the five tech companies realized nearly $250 billion in profit. That's close to $244 billion. And that is GAAP net income, not operating profits, not adjusted earnings, and not the EBITDA figures that many companies use to make their earnings look stronger. There's no need for junking the stats when you're big tech. For all five, the first full 12 months of the COVID-19 pandemic would have been their most successful years of all time if it was actually a fiscal or calendar year. And remember, we're not talking about young companies that haven't been public long. Apple and Microsoft, which went public in 1976 and 1986 respectively, have been titans since well into the previous millennium and have produced huge annual profit and sales totals in the past, while Google and Amazon were products of the dot-com boom that ended more than 2 decades ago. It's even more astonishing to realize that all of these companies, actually with the exception of software behemoth Microsoft, are under some sort of federal investigation for anti-competitive practices and behavior. But maybe that is precisely the point of the investigations. Even amid rounds and rounds of time-consuming congressional hearings and millions of dollars being spent in the first round of legal fees, these companies continue to power on, raking in money hand over fist. And in Microsoft's case, it's been there, done that, at least for now. In all aspects, the growing financial strength and powerful effects on the economy from big tech cannot be ignored. Amazon grew its workforce by more than 50% in the past 12 months and is now the second largest American employer behind Walmart, and the only other US company besides Apple and Amazon that is putting up regularly $100 million sales quarters. In 2020, Amazon hired over 500,000 employees as it started to prepare for more deliveries and more services in an increasingly digital world, with everyone in lockdown in the first months of the pandemic. The number of employees Amazon hired in the past 12 months eclipses the entire combined workforces of Google, Facebook and Microsoft. The monster earnings confirms how these companies are crushing their competition and dominating the US economy. It's a huge gravy train for investors in big tech, but puts a big target on their back for regulators. And financials also weighed in on the broader market as banks slipped on falling treasury yields despite a raft of better than expected data showing an improvement in consumer spending and inflation. Consumers splurged on new cars, recreational goods and takeout food in March after most Americans received $1,400 in government stimulus checks, giving a big shot in the arm to an economy still recovering from the coronavirus pandemic. Consumer spending, as reported, rose 4.2% last month. People were expecting a forecast of 4%, so it was actually above expectations. And incomes jumped a whopping 21.1% in March, mostly because of that federal stimulus. The surge in income and spending last month played a key role in boosting gross domestic product. In the first quarter, the economy grew at a robust 6.4% annual pace against the backdrop of falling coronavirus cases, relaxed government restrictions, and the creation of 1.5 million new jobs. Economists predict even faster growth in the spring as vaccinated Americans get out and about and businesses ratchet up production to meet rising demand. A key measure of inflation, known as the PCE, meanwhile, increased at a rate of 0.5% in March, and that pushes the yearly average up to 2.3% from 1.5% in the prior month, and that's likely to head higher still over the next few months. Americans spent loads of money last month on new cars and trucks, recreational items such as toys and games, prepared food, and many other consumer goods. Spending also increased on hotel rooms as Americans began to leave their homes after being vaccinated. As long as coronavirus cases keep falling, the spending binge is unlikely to abate soon, and businesses are hiring more people and increasing investment in order to meet a strong rebound in demand for goods and services. Services are especially primed to benefit. Americans are flying more, going out to eat, taking a vacation, and enjoying recreational activities that were largely off limits during the pandemic. A high savings rate will also give Americans plenty of cushion to spend. The level of savings shot up in March to 27.5%, about 4 times the pre-pandemic average. The stimulus, of course, won't go on forever, and eventually the US will need to chip away at all that debt that is accumulating to survive the pandemic, but the economy is still gaining steam at the moment. growth is likely to remain strong through to the end of the year, especially if the US recoups most of the 8 million jobs still missing because of the pandemic. The consumer spending of 4.2% up in March was the largest monthly increase since June. This puts consumption and likely GDP on track for double-digit growth in quarter two. The Price Consumption Index, which is the Fed's preferred measure of inflation, was only 0.5% in March and 2.3% annualized. The latest data points to an increasing pace of inflation, but it comes just days after the Federal Reserve kept rates unchanged and continued to suggest that rising price pressures would be transitory. The Fed's doggedly dovish outlook and the White House's spending plans all point, though, to more stimulus and more debt. And the question is inflation sleeping or will it wake? The Volatility Index, which measures the implied volatility of the S&P 500 options, was up 5.68% to 1861, and the euro-US dollar was down 0.77% to 1.2025. Over in Europe, stock markets edged higher on Friday, helped by further evidence that the region is in fact recovering from the pandemic-influenced slump, whilst the first quarter earnings season also continued. Global stock markets have been pushed to record levels of late by signs of a broad economic recovery, helped by vast amounts of fiscal stimulus and ultra-easy monetary policies. More evidence of this recovery came from France, as the Eurozone's second biggest economy grew 0.4% in the first 3 months of the year, from the fourth quarter, when it had shrunk 1.4%. The news, though, was less impressive in Spain, as its economy contracted 0.5% in the first quarter, down 4.3% on the year. But this still represented an improvement on the 8.9% annual drop the previous quarter. Germany's GDP fell even more sharply by 1.7%, rather than the 1.5% which was forecast. The Eurozone has fallen into a double-dip recession as the restrictions imposed to battle the third wave of COVID-19 and save lives hit growth. Eurozone GDP shrank by 0.6% in the first 3 months of this year. That follows a 0.7% contraction in the fourth quarter of 2020, when the strong rebound over the summer faded as new waves of COVID-19 hit Europe. That means the Eurozone is in a technical recession defined as 2 consecutive quarters of negative growth. In the wider EU, GDP fell by 0.4% in January to March after a 0.5% contraction in the fourth quarter of 2020. The fall is driven by contractions in 3 of the Eurozone's largest economies. Germany shrank by 1.7%, Spain contracted by 0.5%, and Italy's GDP fell by 0.4%, which puts the Italian economy into a technical recession too. The decline in output means the country fell into a double-dip recession amid virus lockdowns and the slow vaccination campaign. The nation is second only to the UK in pandemic deaths in Europe. France, though, grew that 0.4%, having delayed its lockdown until the end of March, when a surge in infections that threatened to overwhelm hospitals forced President Macron to act, amid criticism for not acting faster. And elsewhere, the earnings seasons continue, with AstraZeneca up 2.5% after the much-maligned drug maker said it expected higher sales in the second half of the year, and it reported first-quarter profits and sales ahead of analysts' average expectations, including $275 million in COVID-19 vaccination sales. The banking sector remained in focus on Friday, with Barclays down almost 6% after the UK bank reported first-quarter net profit of £1.7 billion, or $2.37 billion US, but declined to release cash set aside to cover bad loans, as its peers had done, suggesting caution still going forward. BNP Paribas stock also fell 1.3% after its better-than-expected first-quarter profit was helped by lower provisions for pandemic-related bad loans. Banco de Sabadell stock climbed 4% after its British unit TSB swung back to a profit in the first quarter after speeding up a cost-cutting plan and seeing a rebound in its equity trading business. And elsewhere, Nestlé rose 0.6% after the world's largest food packaging company said it had bought vitamin and supplements maker, the Bountiful Company for $5.75 billion. Over in Asia, China's Shanghai Composite closed at 3,446 ahead of a week-long holiday beginning on Saturday. The Manufacturing Purchases Managers Index, the PMI, for April was 51.1, which was below the 51.7 in forecast and March's 51.9 figure. The non-manufacturing PMI was at 54.9, also below March's 56.3 reading, so there could be some signs of weakness there. In the private sector, the Caseline Manufacturing PMI for April was 51.9, above the 50.8 in forecast and April's 50.6 reading, and investors now await the PMI due next week. Hong Kong's Hang Seng slid 1.55% as the city recorded its first untraceable case of a COVID-19 mutant variant on Thursday. In Japan, the Nikkei 225 closed up 0.83% to 28,812 as the country returned from a holiday. Industrial production increased 2.2% month-on-month in March. That's higher than the 2% growth in forecast expected, and February's 1.3% contraction. The Tokyo Core Consumer Price Index contracted 0.2% year-on-year in April, which was in line with expectations, and that's lower than the March 0.1% contraction, and this is another sign of an economy where inflation is nowhere to be seen. And remember, they've been at QE longer than almost anybody else. In Australia, the ASX 200 was down 0.8% to 7,025. The ASX 200 Financials Index was down 0.67% to 6,243. The real estate trusts were down 0.62% to 1,468. And the local volatility index was up 6.79% to 1159. The ASX 200 futures was down 0.82% to 6,993. Amongst the banks, ANZ was down 0.69% to 2874. CBA was down 1.07% to 8904. NAB was down 0.41% to 2666. And Westpac was down 0.83% to 24.98. Amongst the regionals, the Bank of Queensland was down 1.11% to 902. Bendigo was down 0.77% to 1033. Suncorp was down 1.22% to 1051. And Macquarie Group was down 0.02% to 160.49. AMP was down 1.76% to 1.11. Genworth was up 0.74% to 274, having declared that delinquencies were a little lower. McGrath was down 0.74% to 0.675, and Yellow Brick Road was down 6.45% to 8.7 cents. AFG was down 2.42% to 282, and Mortgage Choice was down 0.26% to 1.92. Afterpay Touch was down 2.37% to 117.65. And Samick was up 2.54% to 1940. The Aussie US dollar was down 0.66% to 77.13, while the Euro Aussie dollar was down 0.14% to 1.558. The 2-year Aussie bond was down 21.1% to 0.071. The 3-year was down 10.34% to 0.104. And the 10-year bond was down 0.06% to 1.697. The gold Aussie cross was up 0.53% to 2,293. And the Bitcoin Aussie Cross was up 9.36% to 75,511. And data released earlier in the day said that the producer price index rose 0.2% year over year and 0.4% quarter on quarter in the first quarter of 2021. The latest credit aggregates from the RBA for March showed a further jump in home lending, with owner-occupied loans now tracking at a 12-month growth rate of 6.11%, while investor lending was up 0.55% across the same period, giving a net lift of 4.1% for housing overall. But business credit was down 2.64% across the year, and personal credit was still down more than 10%. So overall, credit lifted just 1% over the past year, the lowest ever, while broad money slid back to 9.57% annualized as the March spike last year fell out of the numbers. But the fall in credit and broad money does not indicate an economy in fine fettle. Rather, it's being propped up through more housing lending, thus driving house prices higher, while business lending remains weak. That said, the past 3 months is a little stronger in terms of credit growth, but it's all home lending related, which is why we see the government and regulators spruiking so hard despite the unsustainability of the approach. APRA's mortgage loan data shows banks increased their mortgage books by 0.54% in the month, with owner-occupied loans up 0.71% and investor loans up just 0.25%. Total mortgage exposure is now at a record high of $1.82 trillion, and investor loans fell to 35.2% of the total. Within individual banks, CBA, Westpac and Macquarie were the biggest net gainers, while ANZ and Suncorp were off the pace. Elsewhere, AMP continues to struggle. So the question is, will the announcement of taking AMP Capital public be enough to reverse its fortunes? Nobody really expected that AMP would take its private markets business public, but with a potential Ares deal finally dead and buried, this could be the wealth giant's only way to satisfy increasingly concerned shareholders. But of course the question is it the best option? It's probably not, seeing as departing Chief Executive Francesco Di Ferrier did not believe AMP Capital was capable of building the necessary scale to compete in global markets itself, and advocated spinning out stakes in its various businesses. We are competing against global players. A lot of the trends have shifted to passive, and ultimately it is a scale game. Size really counts in terms of being able to continuously invest in the platform and in global distribution. We have great product. We simply don't have the scale required to grow this globally, he said back in February. Given that clear-eyed assessment of capital's prospects, it's unclear what's changed. What exactly this demerger will do to reverse the fortunes of the wealth business is also unclear. The simplification of the management structure will have little impact on the forces working against financial advice in Australia, although the new CEO, Alexis George, who did a bang-up job of prepping ANZ's wealth business for sale, will likely have more to say on this at next week's AGM. Also buried in the announcement was the fact that a demerger would allow AMP Capital to establish a new brand, the first acknowledgement that the recent spate of sexual harassment scandals at AMP may have harmed the wealth giant's image and led to the flight of a number of high-profile executives. AMP hopes to solve that brain drain by putting in place a new management equity plan to attract and retain talented investment professionals and management, they said. One talented investment professional AMP won't be retaining is controversial global infrastructure equity head Bo Pahari, who has decided to head for the exit. Now, there's been a barrage of criticism which has forced the Morrison government to make major alterations to its Your Future, Your Super reforms. But by backing down from a fight, can they actually avoid it? The government sweeping changes to the YFYS reforms are likely to be met with much relief from within the superannuation industry. The indices against which funds will be benchmarked have been modified to ensure that allocations to infrastructure don't see them unfairly penalised, while administration fees will now also be included in the performance test. But it's abrupt about face for the government that just months ago was insisting that it was impossible to objectively measure the impact that admin fees had on returns. The underperformance measure measures your skills as an investment manager, not necessarily your overall returns. There are some things that can be measured objectively and some things that can't be measured objectively, Senator James Hume told media back in January. Well, it's a mark of good governance when a minister can change their view when the facts don't agree with it. Ms. Hume's insistence that a statement might as well be orthodoxy, even in the face of the criticism that had already been voiced and which would be repeated ad infinitum for months, suggests that other forces are also at work. The government's recent decision to back down on the superannuation increase would indicate that it believes the window for reform is closing as an election looms. YS, in its new state, is likely to get much wider support from both industry and government, but one sticking point remains the investment veto power. The regulatory kill switch, which would allow the Treasurer of the Day to ban any super fund investment or expenditure, even if it's in the best interests of members, must be removed from the bill. It is an ideological overreach the government has provided no justification for, according to Industry Super Australia. That sentiment has been echoed by other industry bodies, including the Australian Institute of Superannuation Trustees. An Australian super boss, Ian Silk, also roundly criticised the veto power in an appearance before the Senate Economics and Legislation Committee, calling it frankly bizarre and entirely unjustifiable. The fact that it can be exercised against decisions that have been made in the best financial interest of members suggests that there's an opportunity, at least, for a very capricious use of this power. There's no clear case made out for why it's being introduced, Mr. Silk said. Given the level of enmity the veto power has generated and the fact that most funds have signalled they'll fight it tooth and nail, it's unlikely we'll be seeing an end to the super wars anytime soon. Which takes us back to this question of, should you go away and sell in May? Well, Leon Cooperman, the chair of the Omega Family Office, told CNBC on Friday that given a coming rise in taxes, inflation, and a reasonably richly appraised market, he has, quote, an eye on the exit. I suspect the market will be lower a year from today, but I don't have to make that guess now. This is not going to end well. Cooperman warned that the pace of market gains since bottoming out in March 2020 following the pandemic-induced bear market plunge couldn't continue indefinitely. I think we should recognise we're pulling demand forward and that the longer-term outlook is not particularly favourable, in my view, he said. Cooperman said he expects Federal Reserve Chair Jerome Powell, who has described a recent pickup in price pressures as transitory, will ultimately be surprised by inflation, forcing the central bank to signal action before the end of 2022. Sell in May and go away, they say. With stocks at record highs, some investors may be tempted to follow that old adage. Now, according to UBS, who published a note on Friday, the hypothesis is that equities tend to underperform in the 6 months from May to October. So investors should sell stocks at the start of May, invest in cash, and then re-enter the market in late autumn. Historically, the approach has worked for Europe, but not as well in the US, according to their note. In the US, a stay-invested strategy has tended to outperform, particularly in recent years. The strategist said market composition in the US market, more tilted towards growth stocks, partially explains the outperformance. The technology sector now accounts for 27% of the S&P 500, or much higher than the 8% weighting for the MSCI European Index. According to UBS, for that reason, investors who tried timing the US equity benchmark for seasonal reasons would have missed the outperformance of growth stocks in the bull markets since the global financial crisis of 2008-9. So using the past as a guide, the UBS team recommends staying invested, even though they also point to historical evidence in Europe that supports a sell-off in May strategy. Over the past 15 years, returns in Europe have been negative in June 80% of the time, according to the report. This has contributed to a sell in May strategy outperforming a stay invested strategy during these years. We are now entering a time of year when stocks have historically found it more challenging to advance, according to the UBS report. With many equity indices making new highs, some measures of sentiment looking extended, and ongoing concerns about the spread of the COVID-19 variants, some investors may be contemplating selling. Ryan Detrick, Chief Market Strategist at LPL Financial, said in a blog on Friday that the 6 months from May through October have been some of the weakest months of the year for stocks in the past 10 years. But with an accommodative Fed, fiscal and monetary policy, along with an economy that is opening faster than nearly anyone expected, we'd use any weaknesses as an opportunity to add to positions, he said. Here's the catch, Detrick said. Stocks have actually been higher during these worst months of the year, 8 of the past 10 years. And gold futures for June delivery was down 0.2% to 1,768. The US dollar index futures was up 0.72% at 91.24. But the US dollar index broke to new monthly lows, and note that gold didn't move to a new monthly high either. In fact, it's not even close to doing so. It's just closed the day below 1,770. This is a clearly bearish sign for gold. And by the way, silver's lack of momentum recently is perfectly normal. In the early stage of a decline, the white metal tends to catch up big time in the final part of a given move. So, with stocks fully priced and potentially going sideways, with gold and silver looking as though they're going sideways or slightly down, is crypto the way to go? Well, cryptos definitely have returned after recent falls. But of course, they are hugely volatile. And really, their value is based on, well, who knows? Now, given where global markets are at the moment, it may well be that sell in May and go away makes some sense. But I think it's probably a case of watch in May and be prepared to sell, because things remain extremely uncertain. And I also want to underscore again that all of the talk about inflation could well be overdone, because there's still, below the surface, significant signs of deflation. And in the deflation environment, stocks are likely to fall. And that is something that's worth bearing in mind. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.